Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. If you observe the chart, from the chart we can take a conclusion that forward premiums are falling. 1 year forward premium, which was trading at 2 rupees 10 paisa, has come down to 1 rupee 90 paisa. 3 months premium, which was trading at 52 paisa, came down to 39 paisa. And similarly, 1 month premium has also fallen from 21 paisa to 12 paisa. So from the chart, we can draw two conclusions. First, the forward premiums are falling. Second conclusion is that near-term premiums have fallen sharper than the longer-term period. Now let us understand why the premiums are falling and what impact it is going to have on our currency. So basically, before understanding why premium have fallen, let us understand how premiums are calculated. Premiums are nothing but the interest rate difference between two countries. If I say USD INR, it means interest rate difference between US and India. So in the last monetary policy, RBI was vocal and said that they are not going to increase interest rate in the last monetary policy. And we are expecting that the Fed is going to increase interest rate in its May monetary policy. So because of that, the interest rate difference between both the countries has reduced, and thus the forward premium have fallen in last 8 to 10 working days. Now let us understand what happens when premium fall. The first thing will happen is that exporter who is selling for a longer period of time, he there get discouraged to sell for a longer period of time. He might be thinking that 3-month premium is 39 paisa, why to go and sell? Second thing, if any trader is there, he also get discouraged to sell. Third important point is that when we have a lower forward premium, we can understand that importers are willing to buy medium term to long term import ka payable. With this, we can conclude that buying can be more and selling will be lesser. So it can create a buying pressure on the pair. So now let us discuss outlook for rupee. The Fed meeting is in the first week of May. Till that time, we are expecting that the volatility in the pair will be on the lower side. So for the coming week, the pair can consolidate between 81.90 on the lower side and 82.50 on the higher side. But as the premiums are lower, DXY is getting supported at 100 level. Rising trade deficit of India, interest rate differential between India and US is reducing, because of which we can see outflow from the debt market, and finally RBI buying at lower levels. These are all indicating that the bigger picture remains the same. Ideally, in the month of May, the pair should move above 83 kind of level. Now let us discuss strategy for thin margin exporters like agri exporter or a chemical exporter. Most of them are taking costing close to 82 level. If someone has taken costing close to 82 level, then we will suggest them that between 82.20 to 82.40, they should cover 60 to 80% of their exposure. For remaining exposure, they can wait the stop loss of 81.70 for a target of 82.80 or 83. If someone has taken aggressive costing, say close to 82.40 or 82.50, they should simply wait with a stop loss of 81.70 for a target of 82.40 to 82.80. Now let us understand strategy for thick margin exporters. The rupee has been consolidating between 81.80 to 82.5 from last couple of weeks. And in those periods, we have been advising thick margin exporters that they should ideally utilize their forward contract and reduce their hedge ratio. Ideally, a lot of exporters had a hedge ratio close to 60 to 65%. We suggested them to go to a lower hedge ratio close to 40 to 45%. Now categorizing them into two parts. If anyone has fallen below 40% hedge ratio, then ideally they should be to the stop loss of 81.70. If they get 80 to 40 or 50, they should start increasing their hedge ratio. If someone is still having an hedge ratio above 40% or 40%, then they should keep patience and they should wait for a higher level of 80 to 70 to 80 to 80 kind of a level. Now let us discuss strategy for importer. The pair is taking support between 81.80 to 82 kind of a level. Ideally, importers should take advantage of this and they should cover their imports for next 45 to 60 days. If they cover via forwards, then the net rate will be of month and May end is close to 80 to 22. But in case if any importer is thinking that the currency might appreciate and is not willing to hedge, then for them we are suggesting an option strategy. In option and in forward, the net cost will be same. The hedging rate will be same, 82.22. In option, they have to do three things. First, buy a call of 82 for month of May, cost will be 51 paisa. Sell a call for the month of May, you will receive a premium of 15 paisa. And you sell a put for the month of May, strike price 81.50, you are going to receive a premium of 14 paisa. So below strategy is going to protect your upside till 83, and if the currency moves towards 81.5, you will get 50 paisa benefit. If you have any doubts, you can connect my team. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे. Thank you.